The new week starts on a positive note after the risky assets cleared the all-important US CPI hurdle last week with minimum damage. Now this week, the investors' attention shifts to Nvidia earnings. The S&P 500's technology stock valuations are at a critical level just before the earnings announcement. So either Nvidia will give the green light for a further extension of the equity rally, or pull the trigger for a broad-based profit-taking in technology stocks. So welcome. This is Swissquote's Daily Market Talk. So remember, the market bulls around the globe celebrated in style last week the softer than expected CPI data from the US. The global equity rally was further juiced by this expectation that a softer than expected inflation in the US would not only allow the US Federal Reserve to start cutting its interest rates sometime this year, but also allow the other major central banks around the world, like the European Central Bank and the Bank of England, for example, to carry on with their plans to cut their own interest rates and maybe cut more than people think they could. So the S&P 500, Nasdaq 100 and the Dow Jones Industrial Index renewed record last week. The big US retailers' quarterly results also hinted that consumer demand in the US may be coming to a slippery ground. The latter sent Walmart shares to a fresh all-time high last week, remember, after the announcement of its first quarter earnings. Macy's, Lowe's and Target earnings are also due this week and also could come to cement the troubled outlook for US spending story that could further butter the bread of the Federal Reserve does and further fuel this reflation trade that also benefits grandly to the stock markets at this side of the Atlantic Ocean. So in this respect, last week also saw the European Stoxx 600 index and the British FTSE 100 index following suit with fresh record highs. The treasuries had their best month also, this year, and the US dollar fell across the board. But note that the US 2-year yield rebounded past the 4.80% level. The greenback kicks off this new week under some selling pressure, but the US dollar index successfully held ground above a major Fibonacci support last week, which is the 38.2% Fibonacci retracement level on the year-to-date rally that distinguishes the year-to-date positive trend from a medium-term bearish reversal. So the soft CPI data of last week could have certainly marked the end of this year's positive trend in the US dollar index, but people still took into consideration that the producer price data from the US, released just a bit earlier than the US CPI data last week, came in hotter than expected by analysts, and JP Morgan's Jamie Dimon said something that made sense as well. He said that costs linked to the green economy, remilitarization, infrastructure spending, trade disputes, and large fiscal deficits may mean that inflation will stay sticky. And he also added that the stock valuations at the current levels are very high and that the chances of rates going up are higher than what people think. And I actually think that he is probably right. But regardless of the warnings, the equity market cleared an important barrier to the present optimism last week. That was the US CPI data, and is looking to jump over the next big barrier for mood, which could be, the Nvidia earnings. They are due to be revealed this very week, on Wednesday after the market close. Now, Nvidia is expected to reveal another blowout quarter where sales may have hit the $24 billion US dollar mark. So this is the company's own prediction, and it is also triple than the sales that they made a year ago. Investors will also be watching Nvidia's fresh forecast about the current quarter, and it's quite hard to say at this moment how the earnings announcement will go for Nvidia this week, because Nvidia made high predictions and beat its own blow out predictions by a comfortable margin since the AI rally started last year. So we will be looking at, well, whether the AI demand starts giving signs of easing. A thing that we know will happen one day, but is this Wednesday that day? Well, I can't really tell. Because remember that big AI spenders like Meta, for example, said earlier in this earnings season that they will be spending more on AI, and all that obviously hints that demand for NVIDIA's AI chips may remain sustained for some more time. How long? I don't know. So price-wise, well, NVIDIA gained more than 700% since the beginning of last year on this AI boom, and is trading at a spitting distance from the $1,000 per share psychological level. So this week's results will either send the share above this $1,000 per share level or trigger profit taking near it. But any misstep from NVIDIA, which has been the icon of the AI rally so far, has potential to trigger a broader market sell-off in technology stocks especially. And note that, well, price to estimated earnings of the S&P 500's technology sector bounced above the 28 psychological level, which actually has acted as an important resistance since 2020. Therefore, the current levels, the current valuations could well be appropriate for a downside correction, and while a potential disappointment from NVIDIA this week could eventually pull that trigger. Or not, we will see. Also this week, well, Canada and the UK are due to announce their latest CPI updates on Tuesday and on Wednesday, respectively. Then the Reserve Bank of New Zealand is expected to maintain its monetary policy rate unchanged at the 5.5% level, and the FOMC is scheduled to release its minutes from the latest monetary policy meeting this Wednesday as well. Now, inflation in the UK is expected to have fallen from 3.2 to 2.1% in April. Yes, 2.1%. That's where the Bank of England wants to see inflation in the UK to, well, start cutting the interest rate. So if that's the case, if inflation in Britain finally lands so close to that 2% policy target, then the Bank of England rate cut bets could take a lift this week and limit cable's upside potential before the 1.28 mark. Elsewhere, the euro-dollar rallied and stepped into the bullish consolidation zone last week, and that was on the back of a softer than expected US inflation data, remember, but the pair sees resistance into the 109 mark. Now, released last Friday, the series of inflation numbers from the Eurozone countries came with no surprise, happily. Inflation in the Eurozone eased in the month of April, keeping the prospects of a June rate cut from the European Central Bank well alive. So, the divergence between the ECB and the Fed outlooks narrowed a little bit last week due to softer than expected US CPI report, but I'm not sure that it could suffice to justify an extension of gains in the eurodollar toward the 110 psychological mark, because the European Central Bank is still in a better position to cut the interest rates. And in commodities, while US crude rebounded and is testing the $80 per barrel psychological offers this morning, the dovish central bank expectations around the world, especially from the major central banks, continue to support the reflation trade, which in return is supportive of energy and commodity prices. Plus, the news of fresh Chinese stimulus measures aiming to address the country's heavily bleeding property market, and the latest and also better than expected rebound that we saw in the Chinese industrial production numbers also support the rally in commodity and energy prices. So the copper futures begin this new week at fresh all-time high levels, and the Chinese CSI 300 index is pushing higher this Monday as well. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.